Hi, Jim Gore from THOR Investment Management here in sunny Cincinnati where spring has finally sprung. We want to do a follow-up from our market update in February 5th on emerging markets. If you want, please go to our website and look at that market update that we talk about why emerging markets are better than U.S. stocks. And here we want to do a follow-up on that, showing another example of why we like emerging markets over U.S. stocks. What I want to show you in this chart is the red line is the S&P 500, the blue line is the emerging markets, and we're measuring this to CAPE ratio, which is a cyclically adjusted PE ratio. High PE ratio means that it's expensive, low, it means it's cheaper. And what you're seeing here at the very end of the chart is that emerging markets are selling for half the price right now of U.S. stocks. This is a different story than back in 2009, 2010, when the blue line was above the red line. This is when everyone was talking about the BRICS, and you have to own the emerging markets because they're growing faster, their demographics are better, they don't have the debt load, and people were loading up into those things. As a matter of fact, when we talked to mutual fund representatives, a lot of them were telling us that most investment advisors were 25 to 50% invested in international back then, with half of it being emerging markets. And we at THOR had nothing in emerging markets back at that time period. Today, those stories are still there, but a lot of people do not own emerging markets or are underweight there. And that is confirmed when we're talking to the same reps that are telling us today that other registered investment advisors are just starting to look at emerging markets. What that means is more money is going to flow to it. If more money flows to it, higher prices, which means you're going to make some good returns on those investments. Now, some people have said that a CAPE ratio isn't really a way to measure whether the U.S. stock market is expensive or not. But one thing that we like to look at this next chart is price to sales ratio. And this is important because it's harder for companies to fiddle with their sales than it is their earnings. So on this one, the blue line is the capitalization weighted S&P 500. And you can see here that right now, on a price to sales ratio, you are paying a higher price than you were back in 2000. So you're paying up a very steep price for those sales. The red line is just the equally weighted index, which shows that, hey, every sector of the market is overweighted right now. It's hard to find bargains, where back in 2000 we were able to find good bargains in other sectors of the market. So where we're overweighted right now is in the emerging markets because they're cheaper, and also energy because they're the only sector that is selling below their historical PE ratio.